2008 financial crisis. It says the public health crisis will weigh on the economic activity, both employment and inflation, and it's causing tremendous human and economic hardship. The virus shutdown, it says, induced sharp declines in economic activity. Now, after 2020, what's interesting here is the Fed projections see the economy running above trend, quite a bit above trend, in both 2021 and 22. We hopefully have a chart here that shows you the GDP outlook and the change. Notice that 2021, we already talked about the 6.5% decline expected this year. Okay, but in any event, 5% for 2021 is the GDP forecast, followed by 3.5% for 2022. Both of those are above trend. So what you're going to have is this sharp decline. I'll do an air chart because we don't have it, but a sharp decline in 2020 and then above trend for 2021 and 22. All the while, the Fed is projecting it keeps a very low interest rate for the next, I guess we might as well say 2.5 years at this point. That's what the Fed is projecting at this point, Kelly.
And Steve, even as you're talking there, the market has kind of changed its mind. Now you have all of the three major averages rallying. So the Dow has turned positive by 26 points. The S&P is up by 7. The NASDAQ is now up 1%. And what in particular makes it strong to you, Steve, relative to the fact that a lot was already baked in terms of expectations?
You know, I don't want to kill a phrase here, but live by the dots and die by and die by the dots. In this case, the dots are giving life to animating. They're putting numbers around what the Fed believes. This combination of we see the economy improving, running above trend to get back there, but doing so with a very low funds rate. And the language in here is pretty strong, I would say, in terms of its commitment to remaining low until, and I'll read that language one more time, which is the second time they've said this, maybe the third. The economy has weathered recent events and is on track to achieve its maximum employment and price stability goals. I think there's a discussion to be had here, folks, about, you know, how far down does the Fed need to get the unemployment rate now? Does 3.5%, is that the goal? Is it 4? Is it 5? It sees the long run rate itself at 4%. Is that the goal where it wants to get to? If so, you could imagine a very long period of time of low interest rates because, remember, if we have that unemployment chart, I'll just go to it here. The Fed does not see unemployment getting back down but to the trend rate of 4% through 2022. So now just think it through if you're an investor here. If the Fed wants to get back to trend unemployment rate and doesn't see it getting there through even past until 2022, that means low rates for a very long time. And if I was in the market, I think that would be a reason to rally.
And indeed, that's what John Bellows just told us, Steve. Thanks. Go ahead, Ty.
So I was going to turn to David Kelly, and maybe, Steve, you'll jump in here, too. What is the track record of the Fed's projections? Are they good predictors, or are they not so good predictors?
They're pretty good, I think, over the years. What they've tended to believe that that growth would be a little stronger than it's actually turned out to be, but also that unemployment would stay higher. So the unemployment rate has fallen more than they thought in the past, but economic growth has been slower than they thought. But it's not bad. But what I think, to Steve's point, there is a very interesting message here. They have the unemployment rate coming down below 10% in the fourth quarter of this year. So they have, I would argue, a V-shaped recovery built in here. They've got the unemployment rate down at 5.5% by the end of 2022. But yet there's still only 2 members of the FOMC FOMC participants who actually see anything other than a 0 to 25 basis point funds rate by 2022. So they're saying that even if the economy is well along a strong recovery in 2022, they're still not going to move rates. So that means they think there's going to be strong growth, a strong rebound, but they're going to supply very ample liquidity anyway. And that's a dual message, which I think will be very positive for the equity market.
So let me pose the same question back to Steve and add one more, and the one more has to do with how. Let me let you just answer the one on the Fed first and how good a predictor they are.
You know, they have times when they're really lousy at predicting even what they're going to do, in part because shocks come along, in part because they just get stuff wrong. They're actually not very good at their own funds rate. But the reason I wanted to respond to this question, Tyler, is because whether or not they're good at predicting the future, what I think the information is what the Fed is thinking right now. That can change. They reserve the right to change these forecasts. And as any forecaster, they reserve the right to be wrong. But if you want to know what the Fed is thinking right now, I don't know that I'd make a bet on 2 years of zero interest rates. I'm not sure I'd make that bet, but I might make one now for 6 months. I might make one for a year right now. Certainly, if you don't get the inflation to come along, the Fed is putting a number behind the commitment here. And then the next question that I think is probably going to be asked in the press conference coming up, it'll be very interesting to hear how Powell handles this, which is, okay, what's the number that would cause you to move on employment or unemployment? If we get down to 7 or 6, or if the unemployment rate comes down faster than you expected, does that change the metric for the Fed funds forecast?
For the Fed, let me make this a jump ball, if I might, Kelly. Just let me indulge me one more. I found myself thinking when they said we're going to keep rates low until 2022, and anybody can jump in here. I found myself thinking and wondering whether the criticism that the Fed got when it accelerated and put rates back up higher was raising rates. Criticism across the political spectrum, most notably from the White House. I wonder if that plays into their thinking that, well, we're going to signal here that we're going to keep these rates doggone low for a doggone long time. I wonder if that's part of it. Mona, do you want to jump in on that?
Yeah, sure. Tyler, look, I think Jerome Powell's been consistent in saying he is not at all swayed by what the president or any external party really says. I do really think he's looking at the economy here, seeing the potential softness and keeping rates low because of that. What is interesting and what's been noted already, a 5% rebound in GDP growth with rates still close to 0%. That's a pretty good backdrop for risk assets. And so I think you can see a scenario where you are pushed out the risk spectrum, where there is no alternative. The Tina effect comes back into play. And so that's something to think about as we move forward as well, if indeed the Fed and some of these consensus forecasts come to fruition. I will say that thus far we've gotten one strong jobs report, and keep in mind one data point does not make a trend. But if we get 2 or 3 similar reports, I think we have an interesting case to be made. So something to keep in mind as we go forward.
If I could, I think there's a little bit more of a positive kind of spin on this. So the Fed noted that financial conditions have improved. That's certainly true with the performance of the equity market. But they've also said they're going to continue their bond purchases at the current level in order to support financial conditions. So what they're saying is, yes, financial conditions have improved, but we want them to keep improving. We want to keep going here. We do not want to withdraw support. And we're not waiting for 2022 to kind of keep interest rates low. We're going to stay at it right now by keeping our bond purchases going at the current level. I think that's slightly ahead of what the market was expecting here. And I think the signal is pretty clear. The Fed's not waiting for 2022 to provide support. They're doing it now, and they're doing it now through continued bond purchases. So I think that is on the front foot here. And, I just want to highlight the bond purchases, I think, are a little bit ahead of consensus in terms of, being on the front foot.
But I think that's a very dangerous game to play with regard to the rest of Washington, because the problem is we already have massive fiscal stimulus right now. And I would argue that this monetary policy is the most expansionary monetary policy we've ever seen, because fast as Steve Mnuchin can print the bonds, the Fed is buying them. But if they're saying that they're going to continue to do that, then what's to stop Washington passing other bills for relief or for stimulus or for infrastructure or for tax cuts or for whatever, even as the economy is improving? And if the Fed keeps on saying we're going to try to keep long rates low, maintain financial stability by buying up the bonds, I mean, it is debt monetization already. Now, this is debt monetization in an extraordinary recession, so maybe that's not as harmful. But if you're in a recovery and you're following the same rules, eventually this thing I do worry that eventually this could end in disaster if we continue this once the economy is healthy again.
Yeah. Could I just say, I think that's actually a little bit
inflation.
Well, if I could just say, I think that's a little bit by design. I think, a few weeks ago, Jerome Powell was worried about medium-term risks and thought that the medium-term risks warranted another fiscal package. Well, the way you get another fiscal package is you keep interest rates low, just as David said, which encourages more fiscal spending. So Jerome Powell's never going to say it that explicitly, but I do think that's in the back of their mind here. The Fed wants more fiscal support for the economy, and they're going to do their part by keeping interest rates low. So it's not going to be made explicit, but I do think that's part of the design, and that's part of the intent, and it all goes in the same direction, which is the Fed understands they're very far from their mandates, and they're trying to provide more support.
Yep.
We have to
Tyler,
wrap it here, but David, I want to let you. Oh, you would agree with that? Okay, good. David,
Yeah,
back to you. You said this could end disastrously. What does it? What do you mean by that? Quick thought, please.
Well, just in the long run, we need to maintain Fed independence. And if you go for years and years and years of the Federal Reserve building up its balance sheet and supporting massive budget deficits, eventually you end up with some sort of financial crisis or some sort of inflation problem. I'm not talking about the next year or two, but down the road, that is where you're headed. There is no free lunch, but right now the Fed is paying for everybody's lunch.
Power lunch that they're paying for right there. Folks, thank you very much. Sorry we have to end the conversation there. Mona, thank you. John and David and Steve.
Absolutely.
We're glad we were able to resolve the audio problems there. Let's get to Bob Pisani now for more on the market reaction to the Fed's decision. And it is a positive reaction generally, Bob.
Yes, Tyler, initially it was not, but the market still believes the Fed's still very much in whatever it takes mode. That phrase, considerable risk to the economic outlook, and considering to keep rates low through 2022, that's a signal to the market they're going to be aggressive. Just look at the S&P 500. Initially, actually, the reaction was the other way. We dropped about 10 points. But as you often see in these things, it reverses. So within 5 minutes, we had started moving on the upside. Now we're about 20 points above where we were just prior to 2 p.m. Eastern time. Rate-sensitive stocks, they're liking keeping rates low through 2022. They're particularly liking it. Real estate was notably negative. It's gotten a little bit better off of that. But home builders in particular have rallied here late in the day. As you can see, they were down notably earlier in the day. Banks, not so much. And you can think about that. Rates low through 2022, maybe that's not so great for the bank stocks. They really haven't done much this morning. They've been weak the last couple of days. Remember, the yield curve had been helping recently, but the 10-year yield have been a little bit weaker in the last couple of days and is down again today here. So the bank stock's not doing much. If you take a look at what the banks have been doing in the last month, the yield curve is a little steeper than it was a month ago. So that's helped the banks overall. And they've had a nice little rally. They're up 18% in the last month. That's the KBE. But they're still way off their 52-week highs, 27% off. S&P's only 5%. And we've had that yield curve, but potential of loan losses and very weak loan growth outside of helping with the government-backed loans for the long time. That's been weighing them down. I think the important thing right now is near rates low through 2022. I also see they said they're going to keep buying bonds at least at the current pace. I thought they might would have maybe formalized the pace of how they're buying. They haven't exactly defined that, but it's been pretty big overall. So market reacting to the Fed continuing to say we'll do whatever it takes. Guys, back to you.
All right, Bob, thanks so much. Let's go over to Rick Santelli now for more on the reaction across the bond market. Rick?
Well, the bond market's had some good reaction. We'll get to that in a minute, but I'd like to draw your attention to the dog of June, and that's the dollar index. You know, the dollar index was close to 99 at the beginning of the month. It now violated. It's now, what, under 96. It's dropped a third of a cent just since the announcement at 2 Eastern. It's been down about 9 out of the last 12 sessions. And for the month so far, it's down darn close to 3%. So that's something you want to pay attention to. As for Jay Powell and company, listen, I'm an old floor guy. I just call it the way I see it. I don't think the Fed dot plots or anything that I would put my retirement account on co-piloting. And I think that their current assessments are a little bit on the pessimistic side. So it is not at all shocking to me to see stocks do better. And as you look down the yield curve, look at 2-year notes. They popped a bit. They're back to where they were at 18. You look at 10s. First impulse was, 76. So we kind of made a new low by a half a basis point, popped up to 80. And now it's right back where it started, basically at 77. The yield curve 10s minus 2s. Bob's right. It's hovering around 60 basis points. On the Friday jobs number, it spiked up to 72 basis points, which was the steepest it's been since February of 2018. 30-year bonds, they've been the best in terms of buoyant yield. They continue to continually come back. And, of course, if you look at what the Fed may do with regard to its purchases, they keep saying they don't want to really control where rates are. They just want to keep things moving in a liquid fashion. And I think that's a key as we get into the press conference. Tyler, back to you.
Mr. Santelli, thank you very much. Good to hear from you. Coming up, we got much more on the Fed decision, the economy, and what needs to be done specifically to create more economic opportunity for African Americans as we rebound from the coronavirus. And we await the press conference, of course, of the Fed Chair, Jerome Powell. It's about 12 minutes away right now. Stay with us. We'll turn to that. It is a virtual press conference. We'll turn to that as soon as it starts. Stay with us.
Insurance.
All right, so the Fed just announced that it will keep rates low over the next 2 years, 2.5 really, to make sure the economy recovers and the job market rebounds. Right now, the unemployment rate sits at more than 13%. And for African Americans, it has jumped from historic lows just a couple of months ago to its highest level in more than a decade at 16.8%. As we await Fed Chair Powell's news conference, we want to look at what the Fed might be able to do to help those hardest hit by the pandemic. And here to discuss is Bill Rogers, professor of public policy and chief economist at Rutgers University. He's also former chief economist for the U.S. Labor Department. Bill, good to see you again. We read the distressing numbers that you provided in your note. There's a wonderful story in this morning's, depressing story in this morning's New York Times by Ron Lieber, talking about the disparities in income between African-American households and white or non-African-American households. Even more alarming, I think, is the disparity in wealth, net worth. What specifically could the Fed do to address or redress these discrepancies?
Yeah. So the most obvious is how they conduct monetary policy. And so today, when I was listening to the announcement of what they're going to do and their forecast for the future, basically what I'm hearing is, from their standpoint, this is what they're setting the speed limit of the economy to be. And so on one hand, it was positive to hear that they're aiming to keep rates low, in that 0 to 0.25%, through 2022, and that will allow communities that need to rebuild, that were, let's say, hit by looting, that they can hopefully get borrow at cheaper rates. It also just allows the economy to run for a longer pace, because focusing on the unemployment rate is great, but we also have to remember we have to focus on the employment population ratio, that's fallen below 50% for women, women of color, even white women. I believe it fell below 50%. And so So letting the economy run with these low interest rates, and while being data dependent and looking for signs of inflation, the longer we can do that, the longer we can. That's what the Fed can do to help to ensure a balanced recovery, a recovery that all Americans experience, and a recovery where blacks don't have to wait 10 years before their incomes, retouch their incomes at the peak or the start of the Great Recession. And then the second thing that they can do is on the lending market, right? Is providing lower cost loans and opportunities for HBCUs or even land grant institutions, states that they're going to have to do deferred maintenance because they've been pushed back due to the pandemic. So it's the monetary policy telling us what that speed's going to be. And if you look at that 4% unemployment rate, the 8% unemployment rate forecast, if you go by the sort of rules of thumb that the black unemployment rate typically is in around 2 to 1 ratio, you're looking at then possibly an 8% unemployment rate, a 10, 12, 11% unemployment rate for African Americans going forward as the economy recovers. But again, though, let's focus on that employment population ratio. We got to get people back to work.
Bill, it's Kelly here. I have a quick question because you have a really interesting point about how holding off on rate hikes late in the cycle helps people like the black community who are often first to be fired in these situations and last to be hired, the very effect that you're describing. But often when we get late in those cycles, the stock market's booming. Everybody thinks, the Fed's helping the 1% and they're just helping Wall Street. How do you change that narrative so that people say, hey, maybe the Fed is trying to help these hardest hit minority communities?
Well, it starts with research. Myself and Seth Carpenter, former Fed economist, back in the late 1990s, we actually looked at and then did a study that was published in peer-reviewed journals and quality peer-reviewed journals, and showed that when the Fed begins to tighten, it actually has these disparate impacts on the unemployment rates of African Americans and even young people and less educated. So it's not just a race thing, an ethnicity thing. And so we had this great experiment, actually, the late 1990s when I was working for Secretary Herman, where the unemployment rate fell to points that we're seeing today, but the Fed was data dependent, was cautious, and let things settle for 12 to 24 months. And so some work I did with Richard Freeman, a colleague from Harvard, we found that if you let that economy run as long as you can without inflation, you end up seeing that the people who had the biggest gains in percentage terms, because they're coming from lower bases, but were young African American men. And then the other thing that has to happen now, along with the Fed now setting the speed limit, we need the folks up in the Capitol and in the White House, that they've got to do more than just talking about more trickle-down economics. What Mr. Kudlow said earlier in an earlier interview of providing tax incentives. He said nothing about making workplaces safe for consumers and for workers, right? Making sure they have the PPE, making sure that they have the training and the guidelines on how to prevent the virus from coming into their workplaces and creating another wave or a round of infections, which could then slow the economy down.
Let me turn to the question of the minimum wage, which came up yesterday as we were talking to Tillman Fertitta, the restaurant and gambling impresario. Let me play the sound that he had yesterday, and then I'll ask a question.
It needs to be raised, but you don't take it from where the federal minimum wage is up to almost $20 an hour. And you say, well, help the worker. The worker's going back to work, okay? That's the best thing we can do is put everybody back to work. But we can have an inflation in retail and restaurants because of the labor cost that nobody's going to be able to afford to go buy anything in a retail store, or nobody's going to go be able to eat in a restaurant.
He was citing there a wage hike to $20 or thereabouts in Berkeley, California, and he made the point that you have a federal minimum wage which he thinks is too low, but then you also have state and local governments acting as though they were countries setting their own minimum wage for their localities, which is their right to do. Where do you come down on this? And his point is an interesting one, and that is if you bump it up too high, you hurt economic activity because the prices go up.
Yeah, I mean, I'm sympathetic with him on the if you think that you're going to make the minimum wage jump from $8 and a quarter or $9-10 an hour up to 20, all in one fell swoop. Yeah, that's not what I've advocated, and that's not what I think many economists have advocated. That they've advocated movements to 15 in increments, right? In reasonable increments, such that you don't get the job loss that he's thinking that you get. And then also right now, I think the way we provide wages and provide support to people on Main Street who filed for unemployment, who are unemployed, who've had their hours cut, I think the way that we help them out is right now is probably not through a minimum wage increase, but is through what's been in the HEROES Act that's been passed by the House, and that is extending unemployment insurance with triggers so that you start to lower benefits or pull back on it once we see the economy recovering. A second check of $1,200 or $2,400 depending upon your household size, and then also one particular group that needs some help, make them eligible for unemployment insurance if they need it. Those are new college graduates, high school graduates who are going to have difficulty. So I think once the economy gets back together and we have faster growth and stronger growth, yeah, I think getting back to moving those minimum wages up is one way to help to have a prosperity that is shared.
We may have to interrupt you as we await Chairman Powell, but let me get a quick answer from you. Does there need to be yet another stimulus package?
Well, I think it indicated in my answer to you, I think yes. The other, along with what I mentioned in terms of unemployment insurance, I think you also need to help out state and local governments. I'm working with Governor Murphy here in New Jersey on his Restart Commission, and we had a budget briefing the other day. If we don't see assistance, we're going to see a second wave.
Don't mean to jump in to this conversation. Fed Chair Jay Powell has just taken the podium. Let's listen in.
Difficult and challenging time, as the pandemic is causing tremendous hardship here in the United States and around the world. People have lost loved ones. Many millions have lost their jobs. There is great uncertainty about the future. At the Federal Reserve, we are strongly committed to using our tools to do whatever we can, and for as long as it takes, to provide some relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. The most important response to this crisis has come from our healthcare workers, and on behalf of the Federal Reserve, let me express our sincere gratitude to those dedicated individuals who put themselves at risk day after day in service to others and to our nation. Let me also thank the many other essential workers across the country who have helped meet our basic needs for goods and services in these difficult times. The virus and the forceful measures taken to control its spread have induced a sharp decline in economic activity and a surge in job losses. Indicators of spending and production plummeted in April, and the decline in real GDP in the current quarter is likely to be the most severe on record. Even after the unexpectedly positive May employment report, nearly 20 million jobs have been lost on net since February, and the unemployment rate has risen about 10 percentage points to 13.3%. As was highlighted by the Bureau of Labor Statistics, this figure likely understates the extent of unemployment, accounting for the unusually large number of workers who reported themselves as employed but absent from their jobs would raise the unemployment rate by about 3 percentage points. The downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the most affected. In particular, the rise in joblessness has been especially severe for lower-wage workers, for women, and for African Americans and Hispanics. In recent weeks, some indicators suggest a stabilization or even a modest rebound in some segments of the economy, such as retail merchandise and motor vehicle sales. Employment rose in many sectors of the economy in May, and the unemployment edged down as some workers returned to their jobs from temporary layoffs. With the easing of social distancing restrictions across the country, people are increasingly moving about, and many businesses are resuming operations to varying degrees. At the same time, many households have been receiving stimulus payments and unemployment benefits, which are supporting incomes and spending. Activity in many parts of the economy has yet to pick up, however, and overall output is far below earlier levels. Moreover, despite the improvements seen in the May jobs report, unemployment remains historically high. Weak demand, especially in sectors most affected by the pandemic, is holding down consumer prices. As a result, inflation has fallen well below our symmetric 2% objective. Indicators of longer-term inflation expectations have been fairly steady. The extent of the downturn and the pace of recovery remain extraordinarily uncertain and will depend in large part on our success in containing the virus. We all want to get back to normal, but a full recovery is unlikely to occur until people are confident that it is safe to re-engage in a broad range of activities. The severity of the downturn will also depend on the policy actions taken at all levels of government to provide relief and to support the recovery when the public health crisis passes. The Fed's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We are committed to using our full range of tools to support the economy in this challenging time. In March, we quickly lowered our policy interest rate to near zero, where we expect to keep it until we are confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. We have also been taking broad and forceful actions to support the flow of credit in the economy. Without access to credit, families could be forced to cut back on necessities or even lose their homes. Businesses could be forced to downsize or close, resulting in further losses of jobs and incomes and worsening the downturn. Preserving the flow of credit is thus essential for mitigating the damage to the economy and setting the stage for the recovery. Since March, we've been purchasing sizable quantities of Treasury and agency mortgage-backed securities in order to support the smooth functioning of these markets, which are vital to the flow of credit in the economy. Our ongoing purchases have helped to restore orderly market conditions and have fostered more accommodative financial conditions. As market functioning has improved since the strains experienced in March, we have gradually reduced the pace of these purchases. To sustain smooth market functioning and thereby foster the effective transmission of monetary policy to broader financial conditions, we will increase our holdings of Treasury and agency mortgage-backed securities over coming months, at least at the current pace. We will closely monitor developments and are prepared to adjust our plans as appropriate to support our goals. The Federal Reserve is also undertaking programs to provide stability to the financial system and to more directly support the flow of credit in the economy, for households, for businesses of all sizes, and for state and local governments. These programs benefit the economy by providing financing where it is not otherwise available. In addition, by serving as a backstop to create credit markets, the programs can increase the willingness of private lenders to extend credit. Many of these programs rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today. We are deploying these lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and from the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox. I would stress that these are lending powers, not spending powers. The Fed cannot grant money to particular beneficiaries. We can only create programs or facilities with broad-based eligibility to make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers will benefit from these programs, as will the overall economy, but for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend and to make decisions about where we as a society should direct our collective resources. The CARES Act and other legislation provide direct help to people and businesses and communities. This direct support can make a critical difference, not just in helping families and businesses in a time of need, but also in limiting long-lasting damage to our economy. At this meeting, my colleagues and I continued our discussion of approaches for conducting monetary policy when the federal funds rate is at its lower bound. The measures we discussed included explicit forms of forward guidance and asset purchases. We used these tools in the aftermath of the global financial crisis, and they have become a standard part of our toolkit. We also reviewed the historical and foreign experience with targeting interest rates along the yield curve. Whether such an approach would usefully complement our main tools remains an open question. We will continue our discussions in upcoming meetings and will evaluate our monetary policy stance and communications as more information about the trajectory of the economy becomes available. We also resumed our regularly quarterly Summary of Economic Projections, or the SEP. The SEP is an input into our deliberations, not an outcome, and it does not represent a committee view. Rather, FOMC participants write down their individual views of the most likely path for the economy, conditioned on each participant's view of appropriate monetary policy. We tabulate those submissions and we publish them as the SEP. Given the unusually high level of uncertainty about the outlook, many participants noted that they see a number of reasonably likely paths for the economy, and that it's not possible to identify with confidence a single path as the most likely one. Nonetheless, we believe that regular publication of the SEP provides a useful perspective on the way FOMC participants are assessing the path ahead. What the June SEP shows is a general expectation of an economic recovery beginning in the second half of this year and lasting over the next couple of years, supported by interest rates that remain at their current level near zero. Of course, my colleagues and I will continue to base our policy decisions on the full range of plausible outcomes and not on a particular forecast. The risk management approach, is the best way we can promote our maximum employment and price stability goals in these unusually uncertain circumstances. Finally, I want to acknowledge the tragic events that have again put a spotlight on the pain of racial injustice in this country. The Federal Reserve serves the entire nation. We operate in and are part of many of the communities across the country where Americans are grappling with and expressing themselves on issues of racial equality. I speak for my colleagues throughout the Federal Reserve System when I say that there is no place at the Federal Reserve for racism, and there should be no place for it in our society. Everyone deserves the opportunity to participate fully in our society and in our economy. These principles guide us in all we do, from monetary policy to our focus on diversity and inclusion in our workplace, and to our work to ensure fair access to credit across the country. We will take this opportunity to renew our steadfast commitment to these principles. We understand that the work of the Fed touches communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to our questions.
For the first question, Nick Timros.
Yes, hi. Thanks, Chair Powell. Nick Timros at the Wall Street Journal. I want to ask about the economic projections, and I realize these are more of an educated guess at this point, but they suggest the committee sees quite a large output gap over the next 2 years. And yet the committee did not take any steps today to reinforce your forward guidance. And so my questions are, first, what are you hoping to learn by waiting? Second, how might that change your response? And third, how close is the committee to reaching a decision on a more concrete forward guidance and whether yield caps might reinforce that guidance?
So first, I would say that we think that monetary policy today is currently well positioned to support the economy in this challenging time. If we didn't think that, of course, we would change our policy now. As you know, we lowered our policy rate very quickly than others, to the effective lower bound. And we said that we'll keep it there until the economy has weathered the effects of the virus and is on track to achieve our goals. You can see that in the dot plot, as I think you pointed out, that overwhelmingly FOMC participants expect as their baseline expectation no rate increase at least through 2022. And if you look at surveys of forecasters and market participants, financial market prices, et cetera, those also appropriately reflect a long spell with rates at the effective lower bound. So the first thing is monetary policy is in a good place, and that's well understood in the markets. Secondly, we've also taken strong measures to support the flow of credit in the economy, as I mentioned. And third, we're continuing asset prices in coming months at a relatively high level. So for all those reasons, we feel like policy is now in a good place. So as we look ahead, we see that the path ahead for the economy is highly uncertain and continues to depend to a really significant degree on the path of the pandemic. So at this meeting, what we did was, as I mentioned, we looked in some depth at forward guidance and asset purchases and looked carefully at those. We also received a briefing on the historical experience with yield curve control. And we'll continue those discussions in upcoming meetings and evaluate our stance and communications as more information about the trajectory of the economy becomes available. I would just say, in terms of what we're looking for, we expect to get a better understanding of the economy's trajectory, and particularly how we should best deploy those tools to achieve those goals. So that's really what we're looking to achieve. And as you can see, we're actively at work on that. We're actively at work on that.
Okay, next, Gina.
Hi, Chair Powell. Thank you so much for taking our question. I'm curious about your inflation forecasts, which are pretty low across the forecast horizon. I guess just given how low you see inflation being over the coming years, why is policy appropriate now, and why not just kind of throw everything you can, everything in the kitchen sink at it currently? And I guess if you could just talk a little bit about what urgency you see in returning it back to that 2% target.
Current policy stance is appropriate. And remember, we're using our emergency 13.3 lending tools to an unprecedented extent. We have asset purchases, and we've now said that we won't go any lower than this. But that we're prepared to adjust as appropriate, and rates are at the effective lower bound. So we have all of our tools in use in a strong way. And so what we're waiting for is to learn more. I think actually, if you look at the May employment report, it's a pretty good, probably the biggest data surprise that anybody can remember. It's a pretty good illustration of just how uncertain these times are. The economy's reopening. We're going to learn a whole lot about the path of the economy in the next incoming months. So that's really what we're looking for. In terms of inflation, you'll know that we had a 128-month expansion, and we never did quite get inflation back to 2% on a symmetric, sustained basis. We got close for the last couple of years, but we never did quite get there. So I think we have to be humble about our ability to move inflation up, and particularly when unemployment is going to be above most estimates of the natural rate, for certainly above the median in our SEP, well through past the end of 2022. So I think we're in the right place now. We are looking carefully at as we learn more and better understand the path of the economy, we will be assessing what's the best way to deploy all of our tools to achieve our goals in the best possible way. And I'll just say again that we are the May employment report, of course, was a welcome surprise. Very pleased. We hope we get many more like it. But I think we have to be honest that it's a long road. It's depending on how you count it, well more than 20 million people displaced in the labor market. It's going to take some time, and we are going to be deploying our tools. All of our tools to their full extent in pursuit of those goals, however long it takes.
Okay, Steve Leeson.
Thank you, Mr. Chairman. I think I understand how the Fed might react in the event things come out worse than expected. I think I don't understand how you might react if things come out better than expected. Kind of a variant on these other questions. How firm is the commitment to lower interest rates? And if things end up better, do you stick with these low interest rates as you projected them? Or is it specific points that you have in mind, for example, unemployment or inflation, that is animating where you might go? And what are those numbers that you're looking for that might cause you to change about the policy as it now is
That's where I would start. I would say, we just had a period of unemployment, as you know, that was well below 4%, hanging around 3.5%, that lasted 2 years. And during that period of time, we saw a lot of great things happening in the labor market, things that we'd love to get back to. We didn't see any problems with price inflation. Price inflation didn't really react much. So I would say, we'd be looking to get inflation back up, and we'd be prepared to tolerate pretty low, welcome, in fact, not tolerate, but welcome very low readings on unemployment, just based on what we saw in the last expansion. So, we're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time. I think most forecasters believe that. It would be great if we got a whole bunch more months of job creation like that. Notwithstanding that, as I mentioned, there are just a lot of people that are unemployed, and it seems quite likely that there'll be a significant group at the end of even after a lot of strong job growth that'll still be struggling to find jobs, and we'll still be providing strong accommodation for that. Strong accommodation for that.
Thank you, James.
Thanks very much, Chair Powell. There have been plenty of comparisons with the Great Depression of the 1930s, the crisis began. Is that scenario sort of that more dire scenario now goes out and we're looking at a more traditional and sudden recession? And are you at all concerned that the strong performance of the stock market in the last few weeks is disconnected from the economic reality?
I think that the Great Depression is a good example or a likely outcome or a model for what's happening here at all. I really don't. And there are just so many fundamental differences. First, the government response has been so fast and so forceful. The origin was quite different. This was an economy that was in a healthy place. Of course, every economy has longer run challenges, and that includes our economy. Notwithstanding that, 50-year low in unemployment and the longest expansion in our history, and every reason to think it could continue. So that's different from what was happening around the time that the Depression started. The financial system this time was in very good shape, much better capitalized. So, it's just not the right model. I would say we're learning. Every month that passes, we're seeing more, we're learning more, and I think particularly the next few months will be very important in learning what the real story will be. Because we'll see the significant incoming data about the opening of the economy, the reopening of the economy. And I would say, assuming that the disease remains or becomes pretty much under control, I think that what you see is a very weak second quarter, historically weak, and then an expansion that builds momentum over time. People will adjust probably a little bit gradually to some of the activities that involve getting together in large groups in close quarters. Those will be the harder parts of the economy to recover. But ultimately, we do see a full recovery over time, and that's really what what I think I'm personally seeing. And you could see significant job growth in coming months as people return to their jobs. But you're still going to face probably an extended period where it will be difficult for many people to find work, and that's what you see in really many forecasts at this point. That doesn't mean it's right, but that's sort of a broad expectation. Certainly not the Depression forecast. A broad expectation.
Thank you, Chris, from the Associated Press. Thank you, Chris, from the Associated Press.
Hi, thanks for taking our questions. Well, in the projections you have, you didn't change, the Fed policymakers didn't change their the forecast for long-run unemployment. So that suggests that that all of you so far don't see necessarily prospects for long-term damage. But still, what kind of data are you looking at here to gauge, the potential for longer-term hits to the economy, even as we have something like the May jobs report? You could still have, at the same time people return from temporary layoffs, there could still be permanent job losses. So what kind of data are you looking at to gauge that potential impact, and what is it
This is a
telling
really
us so far?
important risk, and I think it's not the risk for the next few months, but it's the risk over time. of lasting damage to these, to the productive capacity of the United States, typically in two forms. One, through extended periods of unemployment. People lose contact with the labor force. They get out of touch with the skills that they need, and they have a hard time getting back in. And that it's very damaging to people's lives and their working lives. And it also just lowers, in a way, it can increase the unemployment rate, but it can also lower the labor force participation rate, which is almost worse in a way, to have people dropping out of the labor force where we need them in the labor force working. The other piece of it is just businesses. A shock like this that just comes in, it's like a natural disaster. You wouldn't want a lot of perfectly good businesses, particularly the smaller and medium-sized businesses that may not have a lot of resources to sustain them, to go out of business permanently in a situation like this, where really there was no reason for it. Of course, businesses are going to go in and out of, they're going to fail all the time, and that's a healthy thing in capitalism. That's something that has to happen. But this is different. This is a way, potentially. So those are the things we've been worried about. We didn't change. You're right, though. We didn't change our longer run estimate of potential growth or of the unemployment rate. And that's, I would say, in my thinking, the reason I didn't change mine is that I think we can avoid that, or avoid much of that, most of that even. And we do that with measures that keep people in their homes, that support hiring, that support growth, that avoid unnecessary, avoidable business insolvencies. And that's all the things that we're trying to do. Basically, if you look at what's happened, as I mentioned, there's somewhere short of 25 million people have been displaced, even after the good May employment report. What we're trying to do is create an environment in which they have the best chance either to go back to their old job or to get a new job. That's kind of the most important part of this exercise. And maybe it's probably hopeful at this point to say that we won't have longer run damage to the economy and these numbers won't change. But I think it's way too early to be changing longer run. See, these are not meant to be short run numbers. They're longer run assessments. So I have not changed mine, and I'm hopeful that I won't have to change it. I'm hopeful that I won't have to change it.
Heather Long.
Hi, good afternoon, Chair Powell. I'm struggling with two things that I'm hoping you can provide some clarity on. Is the ongoing bond buying program. You say that it's needed to continue the smooth functioning of markets, but I guess most of us aren't really seeing a lot of instability in markets right now. So if you could kind of give us some clarity of what you're seeing that needs to continue to be smooth at that level and that pace. Second is, you were just talking about Fed concerns about small and medium-sized companies going out of business during this. And I guess, the Main Street lending program still isn't running yet. When do you expect loans to start happening? And do you think the 2-month delay has hurt the chances of some companies surviving?
There have been gains in market function, although not fully back to where you would say they were, for example, in February before the pandemic arrived. We don't take those gains for granted, though. This is a highly fluid situation, and we're not taking those for granted. In addition, as I pointed out in my statement, those purchases are clearly also supporting highly accommodative financial conditions, and that's a good thing. So that's why we're doing that. Turning quickly to Main Street. So I would say that what we've done on Main Street, I think to a greater degree, is we've listened to feedback. So we've been out repeatedly for feedback in trying to create a much more difficult product than really the other facilities. And I think this last set of changes we made have actually been very positive for the facility. I think it's going to be better able to achieve its goals. And so we've used the time well, I think. And now we are now in the final run up to starting the facility. What we did, as you saw earlier, I guess it's early this week or late, whenever we did it, in the last few days, was we lowered the minimum loan size and we increased the maximum loan size. But I think even more importantly, we lengthened the maturity and we stretched out the repayment schedule significantly. So borrowers will get a 2-year delay until they have to make any principal payments, repayments, and a 1-year delay on interest. So we had been hearing from both borrowers and lenders that these would be very helpful. We made the changes. We're putting them through the facility. The next step will be to register lenders. At that time, loans can begin to be made. Shortly after that, the facility itself will be up, and those loans can be sold to 95% of the loans, and it's 95% across the board now in the Main Street facility, can be sold. So all of that should happen quickly now. And I do think this has been a challenging project, but I think we've come to a better place. And by the way, we're going to be prepared to adapt further if we need to, and that's true of all of our facilities. These are unique. There's no playbook here. You have to draw this up and then try it out. And we've been very willing to adapt, and we'll continue to be very willing to adapt, and we'll.
Okay, Matt from Bloomberg.
Hello, Chair Powell. This is Matthew Boesler with Bloomberg News. I wanted to ask you about regulatory forbearance. There were some piecemeal forbearance measures put into place in various jurisdictions and also to a slice of the mortgage market to prevent banks from foreclosing on such debts amid the widespread financial hardships caused by the pandemic. And with many of those set to expire soon and many businesses and households still in dire financial straits, I'm wondering if any consideration is being given at the Fed to more comprehensive regulatory forbearance measures or other regulatory measures to prevent businesses from going under just because they can't meet those payments. There have, of course, been some tweaks to the Paycheck Protection Program on the fiscal side to address this, but I wanted to ask you about things you might be able to do on the regulatory side as well. Thank you.
We can make changes to bank regulation and supervision. I don't know that we have the ability to make changes, for example, in mortgage payments, if that's what you're thinking of, or credit card payments. That's something that could be legislative, or it could just be what the banks themselves are doing. There's been a tremendous amount of forbearance on the part of the banks, and I guess our role there would be to encourage it. But those are not decisions that we hold any legal authority to make. And by the way, we have encouraged those decisions. I hope that's responsive to your question.
Scott Horsley, NPR.
Thank you, Mr. Chairman. I know you're loath to weigh in too heavily on fiscal policy, but given your forecast for elevated unemployment rates, do you think it's important that Congress extend the $600 per week extra unemployment benefit?
I think we try to keep our comments on fiscal policy at a high level, and I'll come to your specific question. But I would just say this. This is the biggest economic shock in the U.S. and in the world, really, in living memory. We went from the lowest level of unemployment in 50 years to the highest level in close to 90 years, and we did it in 2 months. Extraordinary. And appropriately, the response from fiscal authorities has been large, forceful, and very quick by the standards of these things. Roughly $3 trillion Congress has authorized, and that's benefiting households, laid-off workers, small, medium, and large businesses, hospitals, state and local governments. 14% of GDP. It's in a class by itself in terms of both the size and the speed of it. And it's also pretty innovative. Both the PPP and the unemployment insurance are quite innovative in the American context. And there were difficulties in implementing it, but that's really a function of their novelty, I think. Those programs, by the way, let me add, the Fed also, we both innovated and acted forcefully, progressively, proactively, and aggressively as well. You put those together, all of that is making a difference now. You look at the income data, the expanded unemployment insurance and also the stimulus checks have gone a long way to replacing lost income from job loss. I think you're seeing it in the job market data. Many are giving the PPP credit on that front and in keeping small businesses going. So so far, it's a good response and it's having a big effect. You get to the question is, it's big. Everyone can see that it's big. Is it going to be big enough? And that is a question. And the question from the question that I've been concerned about really is this issue of longer run damage to the economy. We're doing a fair job of getting through these first few months, more than a fair job. The question, though, is that group of people who won't be able to go back to work quickly, what about them? And that could be many millions of people, who worked in parts of the economy that will be the slow ones to recover. And, we want those people back in the labor force. We want them getting jobs. So, and they're going to need, probably will need further support. So I would just say this. It's possible that we will need to do more, and it's possible that Congress will need to do more. In terms of the $600 unemployment insurance, I wouldn't try to give Congress advice on the specifics of that. I know they're looking at, I know from both talking to people and reading the papers that they're looking at a whole bunch of different possible approaches going forward, and some of those seem kind of promising. So, we're happy to give advice if people ask for it, but probably not publicly.
Thank you. David Gura.